Hey, best ever listeners. Welcome to the best ever CRE show. This is Beyond Multifamily. I'm Amanda Cruz, joined by Ash Patel. What's up, Ash?
Hey, Amanda, and hello, best ever listeners.
Ash and I are with today's guest, Roger Becker. Roger's joining us from Alameda, California. He's the founder of Street Smart Success, a passive investing firm, and Roger's portfolio consists of 30 passive deals. Roger, thanks for joining us today. How are you doing?
I'm doing great. Thanks so much for having me.
I was waiting for a joke. For the audience to know, Roger and I have known each other for a few years. I've had the pleasure of being on his podcast a couple times. We had lunch last year, and just a phenomenal guy, a wealth of information on passive investments. So, Roger, with that being said, give the audience a little bit about you.
Well, first of all, Ash, thanks. And you're one of my favorite, man. I've done almost 600 episodes of my podcast, and you're like top 5. You're just such a nice guy and generous, etc. And what was your question again?
You don't have to lie to him, Roger. Don't worry about that.
A little bit about your background.
My background. Sure. I came out of the advertising business, started in the town where you sit in right now, Ash, assuming you're at home, in lovely Cincinnati, Ohio, where I went to college, native Buckeye. And I, along the way, have been passively investing for 25 years, started very, very slowly, and I've really ramped it up in the last 5 years. There have been some capital events, and I need to generate cash flow.
You've made a lot of money. Was it by selling a company back in the day?
Well, we should start by defining a lot of money. I made a lot of money running my business. I did not make a lot of money selling my business. I sold it it was at a down, and I just wanted to get out of it. Not life-changing by any stretch of the imagination. But when I ran my business, which I had for over 30 years, the last 20 years, I made a lot of cabbage.
Did you retire when you sold the business and never look back?
Yes, I stayed on for a few years, really as a figurehead. I sold it to a partner, and he and I had a very good relationship, but he sold the business a couple years ago, and the people that acquired it from him did not want to continue paying me what he had been paying me, so we parted ways. So I've been completely out of that business for going on 2 years.
Okay, but you've been passive for 25 years. Did most of your income come from your passive investments?
Oh, no. Until 5 years ago, I just had a couple things. I was and still am invested in a multifamily guy, one of the top 50 in the country, based in San Francisco, a friend of a friend. And I put money in with him 25 years ago, and it's still there. They keep 1031ing and 1031ing, and I never take the money out. And maybe a couple other deals along the way, a long time ago. But 90% of my experience investing passively is in the last 5 years.
All right. And you've had a few screw ups there, haven't you?
A few would be an understatement.
That's where we learn, right? Let's dive into those.
Well, I also did stuff on my own that, where I can't blame anybody else, because I'd much rather do that. But at one point, my wife and I, 20 years ago, we had gone out and bought like 20 new homes all over the country back in like 2003, 2004. We didn't do anything fancy. We weren't buying stuff at auction or foreclosure. We had no idea to do any of that. And I was working my business and running all that. We went and bought like 20 homes, and like there was across Phoenix, Florida, Las Vegas, and Bakersfield. And we were just putting 20% down. And I kind of thought, and we were doing 15-year loans. And I kind of thought at the end of 15 years, they'll be paid off, and I'll have like 20 grand a month coming in, and I'll be retired 15 years from now, which would have been about 5 or 7 years ago from today. That's how long ago it was. And what happened is we got really, really lucky on the timing. It was just ridiculous. It was like no doc loan time. Anybody could get a loan. And our properties like collectively appreciated like $1.5 to $2 million like within a year or so. It sounds fantastical, but it was really a crazy time. And we took that money off the table because I felt, man, this is aberrational and this has nowhere to go but south. So I did have the presence of mind to get out of most of those that I could. Some were new construction, and I got holding the bag and lost a lot of money there. But the rest of them, we made a ton of money. And then with that, we bought a single family Section 8 in Buffalo, New York. And, I live in an area where, even then it cost $1 million to live in anything any of us would want to live in. We were paying $50,000 a door. And I ended up losing my shirt. I mean, you couldn't keep them filled. The tenant base would do just incredible amounts of damage, et cetera, et cetera. So, I left with my tail between my legs, losing probably about $400,000 net.
It sounds like real estate's not your thing. Either that or write a book on what not to do. You cashed out of a lot of those single families. The hit that you took on the others, were you still net positive on
comparing those two? Yes, I was. Yeah, comparing how much I made on single, the ones I bought, and then the Buffalo debacle. Yeah, I was positive.
Okay, so Roger, you learned it's really not worth doing all this yourself because you're semi-retired. You don't want to dive into this full time and buying houses all over the country. How the hell was that a good idea?
It was stupid. It was an absolutely ridiculously stupid, terrible idea. Your point is well made, and where we made all that money, because the market went Zulu in 03, 04, 05 is pure unadulterated luck. Yeah, I'm lucky I didn't lose at all. Yeah, you're right.
But in Roger's defense, man, it was a crazy time. Single family home prices were going through the roof. You could buy anything and it's appreciating.
And how freaking smart to get out. Nobody else got out. You're the only one that did.
Yeah, I appreciate that. I mean,
well, you said you prefer to buy them yourself,
but I've lost a lot of money doing other
right?
things too, though. The story didn't end there. I've done a bunch of other stupid things too. Yeah.
Did you say you prefer to buy yourself? You just also do passive investing, or do you now just prefer passive and don't do anything yourself?
Yeah, sure. Great question. No, because I've lost money on most of the things I did. So I bought like a 5-unit building in San Francisco in 2015. And my thinking, and the rents were like, across the 5, let's say, units, approximately 1,000. The biggest one was like for $600 a month. The market on it at that time was $4,500 a month. And the tenant was 86 years old, and she was at the top, like of the 3rd floor. I'm like, eventually she's not going to be able to walk that high, right? But I want to condense this because I don't want to go on forever like all my guests do on my podcast. So basically, her unit where it was like, and then if you can then get $4,000 more per door and multiply that times 15 gross rent, that's how much in value would be created by one tenancy, right? So a few years later on my birthday, my wife and I were in the city in San Francisco. We live outside of the city, and we were doing a brunch, and it happened to be near the unit, the building. And we walked by for me basically to stroke my ego and feel good that I own this place. And the daughter of the old lady was there, and she was like 42 or 40. And it was, hey, how are you? And very pleasant. And she, reaffirmed how much she loves the place. She stays there a couple nights herself, and she lived like 45 minutes outside of San Francisco, but she worked in San Francisco, so she would spend time there, and she couldn't, praise the situation enough. And I walked away with my wife, and I said, when the old lady, her mother, dies, the fact that rent is still $600 and we didn't have an estoppel in the Republic of San Francisco, she will effing stay there. Okay. And she will stay there another 40 years because she'll just, for 2 nights a week, she'll keep it for $600 a month. and we will have an 80-year tenancy, because the old lady had moved in 1975. And that's when I said, we've got to sell this property. I was thinking to backtrack. I was thinking, look, eventually, even 15, 20 years from now, these tenants are going to be gone, even if it's 20. And I had upside of about $250,000 in rents, conservatively, because that is one thing I do know is San Francisco and its rents. I thought I could wait that out. I was making a ton of money, to Asha's question earlier. And really what proved to be the case is I realized none of these people are ever leaving, because even if they want to, they can't afford to. And they all wanted to stay in San Francisco. Who wouldn't? When you're paying $900 a month, $600 a month, what are you going to go move and pay $4,500 when you make no money? So this and other mistakes, I eventually realized I'm not good at this. I suck at this, and I'm too young to figure it out. And I'm too risk averse. I can't lose any more money, and I'm too young. I'm in my mid 60s, I hate to say. So I decided I gotta invest with other people that know what the hell they're doing.
That's where you learn, right? All those battle scars is how you learn later in life. So investing with other people, that comes with its own learning curve. How is that?
Disaster.
But you're still doing it, so it's not bad, right?
Before we get too far into this,
I'm trying to be funny, but by the way, there have been disasters. But go ahead,
Roger. Does this story end well, or is this just all doom and gloom? This might not be the podcast for you, brother.
I love Ash. I do, and I love you too, Amanda. But I've known Ash longer.
Show.
You know what? Here's what I'll tell you. So I've done 30 investments, thereabouts. I haven't counted the exact number, but I will say this. And I've probably made, I haven't counted, but probably half of those in the last 3 years. Every deal I've invested in the last 3 years is performing. 80% of those, according to Performa, the rest of them are still cash flowing, not according to Performa, but they're cash flowing. So it does. I am a doom and gloomer. I'm a super negative guy. I probably do this to prevent myself from making more mistakes instead of patting myself on the back and going, oh, a handful of these are working on our smart. If I do that, I'm going to continue making mistakes. So part of me wants to tell myself you're an idiot to prevent myself from making the mistakes I made early on. And when I say early on in this context, starting 5 years ago, most of my investments are doing very well.
We're heading into some really uncertain economic times. Would you still continue to deploy capital?
Good question.
Or would you pull back?
I will pull back, but I think certain asset classes are more inclined to be resilient than others. And the one that comes to mind, maybe because I pulled the trigger on this very recently, is mobile home parks. So I recently gave a green light on a mobile home park where the lot rents are like $180, and the comps, if you believe the comps, who knows, but are $450, like $500 a month. And this is like the bottom, like it's unless they want to be homeless, they're going to continue to cough up a couple $100, a few $100, even if they don't hit pro forma. So, but generally, yes, I will be cautious.
That's probably legit coming from a mobile home park background. But Roger, you said, in times of uncertainty, you might pull back. Is that not the best time to be acquiring in times of uncertainty? What do you think?
Yes, good point. But, we're talking early April of 2025, and the reality on the ground changes by the hour. You guys may have noticed. So, if things stabilize, or if we have any semblance of stabilization and things are headed down, the founder of BlackRock is, what's his name?
Larry Fink.
No, he's not the founder.
The founder.
The founder everybody's heard of. My God, I'm in my mid 60s. I said, Steven Schwartzman said, buy 10% off the bottom. So that's a hard thing to time, right? Because here's the bottom, it goes up 10 and then it could go down 20, who knows? But the sentiment is, and yes, of course, but right now things are, as of this moment, the tariffs were announced like 2 days ago. Who knows where the dust settles, but sure.
So what do you like right now outside of mobile home parks?
I like everything, despite the doom and gloom. I like everything. So Ash and I did a podcast last week. Ash is very bullish on suburban office. He's got a thesis, which is very compelling. So if somebody put that in front of me and they said, here's a great submarket and, these are great tenants. So I don't say no to anything, a blanket no to really anything that I could think of. I don't think there's any asset class I say I wouldn't not invest in.
The deals that went to shit, were those all multifamily?
Brilliant question, Ash. That would require me. I think most of them, yes. One of them is assisted living, and it might be resurrected. But inexperienced operator, and that's on me.
Inexperienced operator in the assisted living?
Yeah.
Okay, I was going to say, it's pretty hard to screw that up. Right? There's so much demand for assisted living.
But assisted living, though, is a very, very demanding business. It's a business, right? It's hospitality times 10. That's people with special needs, and you're dealing with governments that are paying you. It's funny. One of the challenges has been the tenants or whatever patients, they die. So, and they're very labor intensive to run. And in this scenario, it's a portfolio of 9 of them. And I hope nobody can pinpoint the sponsor because he's a very, very good guy, actually, on a personal level. But they're very small. And the problem is to get somebody to run one of those, it'd be an executive director level kind of person, really cost $125,000, $150,000. And these facilities, they're small. They can't support that. So it's hard to run these things with, at a certain expense level. That's something I've learned the hard way.
What would you like to see differently if you looked at another residential assisted living opportunity?
Sponsor with decades of experience.
Just that?
Yeah, I mean, here's a perfect world scenario for me in a world that's not perfect, is somebody that has multi-decades experience in one asset class. They only do it in one market. And then the cherry on top is that they're not even really syndicators. Their motivation is to take down deals for themselves and then bring along capital to help them take down a deal. And ideally, they're putting in, as much money as possible. But when somebody tells you we're putting in $1 million of our own, and it's too big of a deal for them to be able to take it down or want to take it down because it's be too much percentage of their net worth. That's a good spot. That I like. And I guess the cherry on top of the cherry is somebody that maybe I know personally knows them and has invested with them for many years. Like, hey, this is my college roommate and I've invested in every deal he's ever done and he's a super good guy and blah, blah, blah. Mitigates a lot. There's always risk, but those things mitigate a lot of risk.
Absolutely. That's a really good point. Joe Fairless has said this before too. Like, he likes to invest with individuals who have something to lose in their social circle, in the same social circle. If you have people who are looking at you, you're going to perform better. You're going to try harder than if nobody knows you or nobody knows somebody who's invested with you.
Right. And if you got $1 million hard of your own too, and you're not a billionaire, that keeps you engaged.
That helps.
Yeah. What are some compelling deals that you've seen? Not so much asset class, but the structure of the deal. And I'll give you an example. I would love to see where the sponsors get paid last and whatever fee money they have gets escrowed. So LPs get the first money out no matter what. Have you ever seen that?
That's a great question. I'm so bad at evaluating deals. I mean, my deals are they don't get paid till we get all our capital back as LPs. I don't know if that's the same as what you're describing. It doesn't sound like it.
The problem is a lot of them still make fees on the front end.
Got it. I've not seen anybody forego all fees, including acquisition fees. I've not seen that. It's a great.
I think
great
they should
point.
start escrowing them.
Yeah.
Where they don't get them unless the LPs get their principal back.
Yeah, brilliant. Yeah, I've not seen that, but that's brilliant.
We'll start doing that. We're going to start doing that.
Good.
Do you like to do syndications, Roger, or joint ventures, or both?
Syndications or joint ventures. What's the difference?
I mean, so when I'm thinking of joint venture, it sounds like what you were describing here, right? You and maybe the sponsor in together, they're putting in a ton of money, but maybe they don't have enough. And you bring in the other portion and it's the two of you or what, 3 or 4 of you total, right? Versus a syndication with a legal syndication structure that costs a heck of a lot more and a ton of more passive investors. Do you do both structures? Do you have a preference?
I've not come across any JV opportunities, but it sounds like that would be preferable.
I don't know. We're trying to keep, I want to use our remaining time to keep him from making more mistakes but identifying what it is that got him in trouble historically. So Roger, the JVs, you would bear some responsibility potentially if the deal goes south. There's not 50 investors. There might be just you and somebody else, right? At times the operators might look to you for input. Probably not ideal if you want to be really passive. If you have a desire to step in every now and then, JVs could be great. But let's go back and all your years of experience, let's figure out a solid game plan going forward. So you mentioned submarkets. How important is that amongst all the other metrics?
Great question. I mean, incredibly important.
Okay, well, let's take it a step further. South Florida has had a huge run up. Do you think that's still a good submarket? Or would you rather invest in places that haven't had that parabolic rise?
I mean, the way you put the question, I'm
trying to feed you the answers here.
you just want me to connect the dots.
No, look,
we're painting by numbers here. Okay. Yeah. But you know what? All joking aside, it's kind of like, I guess where my brain goes is to you're really making a point. I get that. So South Florida is already, it's already exploded. Okay. For lack of a better term. In my mind, probably in any asset class, there's always a deal somewhere with a great story, even in, near Times Square in Manhattan. Somewhere, some grandmother, husband died and doesn't, there's a story everywhere. So it comes down to the sponsor for me. It really, really does. If somebody is my best friend's best friend is in Miami or Fort Lauderdale and they're in multifamily, which I'm not really that excited about. And I know you're not either, that there's some rationale and somebody's been doing this for 30 years and they're putting $1 million of their own bucks in. And the thing is, 3 blocks from where they live, I'm open to the story. Is somebody in Indianapolis, or I just podcasted a guy that buys stuff in markets in Indiana and people in Indiana have never heard of. That's how small it is. And, they're buying it at 50 a door, this kind of thing, but they just started doing it 3 years ago. Right? So I'm looking for somebody that knows what the heck they're doing.
Roger, you've been investing with people who have decades of experience who buy assets next door to them in the best submarkets. How the hell has anything gone wrong? All right. So what has gone wrong other than this residential assisted living?
Well, it's taken me a bunch of years to get to what I just described to you. So what I just described, none of those have gone wrong. And in fairness, most of my deals have not gone wrong. But unfortunately, I fell in love with one sponsor very early on, and I just put too much money in to one guy, and it's biting me in the ass. And then now I'm getting to the point where I'm gun shy now, and I'm putting like 50 grand into deals that 5 years ago I would have put, a lot more.
What a dilemma, because I did the same thing. When I was investing passively in apartments, it was all with one operator. And I got out in 2019 only because our deals were making a lot more money and multifamily as a whole was just coming down. But I would feel safer with that. Amanda, what are your thoughts? I would rather, if I have a good track record with one syndicator, why not keep going than try to court a new syndicator and figure them out? What would you do, Amanda?
On the passive side, similar to you, I only invest in multifamily passively. And I currently only have money with Ashcroft because they have all the things, the decades of experience and all the pieces. I would invest with other operators. I haven't been seeking them out because I put most of my money in the stuff that we do, but I would if I felt like they were equally at the top of operators similar to Ashcroft. And in different locations, right? Like I wouldn't put all my money into one fund or one. I like having a couple different ones that have all been vetted, but I don't want too many.
But we say that now that the dust is settling, right? If this was 2018, 19, we probably would think differently. Just keep going with the same operator. I would.
I guess I think it's good to it's fine to have a favorite, but I do like to have diversification in a lot of different ways, including operators, locations. Like I've skipped over on a passive deal because it was located too close to where my assets are. I'm like, well, that's not that much diversification. So you can skip out on different things. I like to be spread out.
Maybe she's smarter than us, Roger. What are your thoughts on
definitely that? Yes.
Okay, so diversification amongst operators, locations, and asset classes. What are your thoughts today on that, Roger?
Certainly across asset classes, right? And so that almost makes one sponsor probably not viable. Most too new. So when I say that, like in the last few years, everything I've done in the last few years is doing well or okay. None of it's not performing at all. It's still new. So when I say in the last few years, that includes a year ago, includes 2 years ago. So, I used to hear you should know, like, or trust your sponsor, like when I started doing this in a meaningful way, like 5 years ago. And I would think to myself, first of all, it's a fairly obnoxious cliche. It's a little too cute for me. But the other thing is that I thought to myself, I don't need to like somebody. I'm a tough guy. Make me money and I don't care. And now I've learned a number of years down the road, it's very important to like somebody because communication is really important. I've got my life savings on the line. And oftentimes things don't go as according to plan, and they never go according to plan. And so I do want to like the person. It makes it a lot easier. And I guess the asset class thing, I would want the one thing that I would probably never invest in, even if it were my brother, is because if they just did one asset class, that's risky.
What about hold period?
And I'm sorry for these long answers, man.
No.
Now I sympathize with my guess. Hold period. That's a brilliant question. I kind of prefer shorter holds just because it takes risk off the table and it's in velocity of capital. I like getting my money
But if you
back.
have your capital returned and you're getting infinite returns and you're de-risked, do you still feel the same way?
Yeah, no, such a good question. I think that if I love the asset, I'm cool with it hanging. And I guess in that case, yeah, I would prefer, if I love the asset, a longer term hold.
All right. So I see now a lot of these big syndicators, they're going to what they call generational funds, indefinite, open-ended funds, multiple asset classes. And their pitch is over the next few years, we'll return a portion of your capital. So you end up with those infinite returns. But they're also pushing the fact that they're diversifying across multiple assets. I just think when you give somebody that long of a runway, they can outrun mistakes, right?
Isn't that the point?
No, because they're not held accountable. If I have a crappy deal and I say, hey, give me 10 years, give me your money for 10 years, I'm going to make a lot of money. Anybody can outrun a bad deal in real estate over 10 years.
What do you mean outrun? Sorry, Amanda.
Time will fix most mistakes. Right? So the market will ebb and flow, but theoretically over time, it should end up higher than where it is today. So a bad decision, you have 10 years to make up for that. I think sponsors should be held accountable and return money within 5 years like they used to, right? The mid-teens, 2000s, everybody did a maximum of 5-year holds. A lot of them exited early with much higher than anticipated returns. Well, now that things have gotten harder, they're saying, oh, hey, give us 10 years. This is better for you. It's generational. You can hand it down to your kids. It's just marketing nonsense, right?
It's funny.
They want your money for longer because, and we've had some guests on here where I've asked them and they were honest enough and they said, we don't think we can deliver on our promises within 5 years.
Which means
that's not okay.
Yeah. Well, it sounds to me they're in an asset class that, well, I guess the first thing is the difference between, like you were saying, 2015 and now. Interest rates were just plummeting, right? So everybody did well, right? So, and that is ahistoric, and that's not going to be repeated. The converse could be true. I mean, they could go up. Yeah. I was going to say something else, but I forgot what the heck it was.
We were just talking about timing, right? Like, I don't want to give my money.
Are you okay with investors holding them for 10 years? I don't have a problem with it at all, honestly, because I think a lot of people who are passively investing want that lower risk and they don't want to have to recycle their money all the time because then it's like a job again. If you're truly passively investing, then why not potentially, if you like the deal, get in it for longer? What do you think, Roger?
Generically, I would agree with that. It seems like in the value add space, it seems like the biggest bump that you're going to get, irrespective of the economy, is in the first few 5 years. So from that, if that's true, and if that's true in a given asset, I think I'd prefer my money back after 5 years. And you make a good point about risk and also effort and in terms of finding an up leg. But I like getting my money back and taking risk off the table. That's the other issue. You're taking risk off the table, staying in the asset as well. It just depends. I guess it's not one size fits all.
Amanda's also like half of our age, so she's got plenty of time to do these 10-year holds.
And your age and my age is not the same either. So she's probably half of my age.
Are you actively looking for additional sponsors and deals?
I wouldn't say active, but I do it purely opportunity to opportunity. I effectively have no plan. So, which I don't suggest for anybody. I have no strategy and I have no plan. And so it's just deal by deal by deal. Who do I meet? This and that. And, like a deal last year came up where a fellow passive investor, he's one of the 2 or 3 people that actually listen to my podcast, somehow contacted me. And he has been investing for many years with his landlord up in Seattle, who's a fairly sizable. I mean, I don't even know if he's sizable, but he's a local Seattle guy, was a broker, office, industrial broker there for 40 years, has been syndicating for 20 years, let's call it, had a portfolio, has a portfolio. Somebody wanted to get out of it, an unhappy LP that was like part of a family office. There was a story, and he needed to backfill that money that he had to return. And so Seattle is a fantastic booming market. Yes, will there be downturns? Of course, but it's a gateway market. It is absolutely booming. Conservative sponsor with a incredible track record. Am I cool putting money in that portfolio and letting it ride for long term? Yes.
Roger, years ago, I was investing in a lot of businesses and I had a lot of deals come my way. I took what I thought was probably the lazy approach where I just put a team together of friends that are retired CEOs, VC guys, different industry experts. And I did that so we can all gather in one room and they can do a lot of the underwriting. And I still ended up making a lot of bad decisions. But have you thought about that? Going in with a group of people with similar goals and mindset. And this way, all the decision making isn't on you. You've got 5, 6, maybe a dozen people where you kind of share ideas and you throw stones at each of these syndication opportunities?
Well, I'm involved in a member of a investor. I don't even know what to call it. It's not a club. It's a group, and it's got like 4,000 members. And you guys have probably heard of it. Something like 70% of the people have advanced degrees, which in and of itself probably isn't incredibly meaningful. I, by the way, am not one of them. But you got smart guys with a lot of experience. It's not exactly what you're describing, but a deal comes in and it gets vetted by lots of people, which, by the way, is in probably not coincidentally, is when I say that I've not made any mistakes. Well, knock on wood. Who knows what's going to happen? But in the deals I've done in the last few years, I got involved in this group exactly 3 years ago. So, and then I have a guy that helps vet deals that has a lot of experience. I am in a small group of guys that does exactly. We don't pool our money. It's more like we talk about deals. But in this particular case, not the big group I'm in, because you got a lot of guys with a lot more experience that are infinitely smarter than me. The other group I'm in, the small group of maybe 10 to 15 of us, sometimes I don't think that the people there really know that much more than I do. And so, it's not as much value as the other group.
Good. So that spreads out the decision-making a little bit. I like that.
Yep.
Closing remarks. Amanda, what'd you think of Roger?
Hey, I appreciate your candidness. I appreciate that. Hopefully, best ever listeners got a little bit of the what not to do, as well as what's been working for you. I appreciate that.
Yeah. My advice is don't do what I did.
I think Roger is a humble, great individual. Glad to be friends with him. And Roger, thank you so much for your time today.
And Amanda, thanks. You guys did a great job.
Thank you.
Talk to you soon.
Best ever listeners, thanks for joining in today. If you enjoyed this episode, make sure you leave us a 5-star review and share it with somebody who could find it useful. Please follow, subscribe, and of course, have a best ever day.